Getting ready to hit the live button. Here we go. In 3, 2, 1. And we're here. Thank you for joining me. I'm Mitch Goldberg. You're watching my live stream, 4:30 every Monday through Thursday. When the market closes at 4 o'clock, we get ready for the live stream. Think of me. Tune in. If you can't watch, stream it in your car. Listen to it in the background while you're working. Put it on. I'm on LinkedIn. I'm on YouTube. I'm on Facebook. Check it out. It's a good show. I put my heart and soul into the show. You want to know something? It's the educational show that teaches you about personal finance and investing. So why wouldn't you want to listen to it? I'm a financial advisor and financial educator. I became a financial advisor 31 years ago. I've learned a lot along the way. I've seen all kinds of clients overcome all kinds of financial challenges. I'd like to say with my help. Yes, definitely with my help. So that's what makes this show worthwhile experience. And I want to share it with you. I give it all away in the hopes that you will become the boss of your money, not your money becoming the boss of you. It's very easy for that to happen, to lose control. Today, what's the deal? I'm like the Shakespeare of financial advisors, to mask or not to mask, because investors are going back and forth. Maybe they should say to keep the reopening going or to slam the economy shut right now because of COVID and the Delta variant. That's what we're going to talk about. We need to make some decisions. We need to make sure you, as an investor, as an economic participant, can get through this. A couple of tips that we're going to share. So let's roll the quick intro, and then we're going to get into it. So away we go. That didn't work out too well. I don't know. I'm having trouble with this. I might have to delete it and reinstall, but I'm going to do it one more time. Here goes. All right. I've been hearing I'm in a group of other live streamers. I've been hearing there have been some difficulties lately, so we're going to have to check that. I'll try to get the intro again in a little while, kind of like an intermission. But welcome. If you're just joining me now, this is my live stream. It's called Be the Boss of Your Money. It's all about personal finance. We're talking about the economy. Now, the economy and the stock market, I know we like to think of those things as the same thing, but they're not. The S&P 500, which is how most of us think about the stock market, it's an index. It's the main index. It's the benchmark index for the whole world. But you can nevertheless invest directly into an index, but you could invest in a security that tracks or mimics an index. There is a difference. But let's say you're in the S&P 500. What is it really measuring? It measures performance of the stock market. It doesn't necessarily measure the performance of the economy. The stock market has continuously been outperforming the economy ever since we went into the pandemic. Remember, we had that quick downswing February and March of 2020, like a year and a half ago. Market tanked to almost 40% in like a couple of weeks, about 4 weeks. Fastest correction of that magnitude ever. We came out of it pretty darn fast too. Why? Because the biggest stocks, the companies with the biggest stocks, the biggest valuations, okay, biggest market caps, like Amazon and Apple and Facebook, Nvidia, Netflix, Visa, Microsoft, Google, the top 10 or so biggest companies, in particular the top 5, those companies were ideally suited to enable us to work from home, to work remotely, to share information, collaborate on projects. We load things up, we upload things into the cloud so our fellow workers, our coworkers could have access to the spreadsheets, the documents. That trend has been going on a long time, but the pandemic certainly accelerated it and proved to us that a good many people can actually work from home. A lot of people can work from home. So I certainly did it with no problem. Was it an ideal situation? I like my office, but it's different for me because my office is like 5 minutes from my home. So it's easy to get back and forth. Anyway, there's a difference between the S&P 500 and the economy. We measure the economy with GDP, and GDP has been pretty strong. Employment has been pretty strong. So we need to do a little walk back to last Friday because I don't do the show on Fridays. Um, just I do it Monday through Thursday, and it just became it's a lot of work to put the show together. I enjoy it. Don't get me wrong. I'm not complaining. Um, you know, um, so I'm gonna keep doing the show. But I figured, last year during the summer on Fridays around June, I realized very few people wanted to actually watch the show on a Friday. So I figured, Monday through Thursday is good enough, and I'm just going to keep it that way. Makes my life better. Okay, so we need to take a look. So we need to do a quick review. Friday was a significant day because you had the non-farm payroll figures come out. Every month we get the Department of Labor that comes out with the non-farm payroll figures. It's the most important statistic. It's I would say more important than the GDP figures we get every quarter. It's real. I know you're saying how could that be more important, but I'm telling you the employment figures move markets and give you a better indication of economic strength than GDP because GDP is so backward looking and it's subject to revisions and seasonality. Um, I don't even know why GDP is announced when it is. By the time you see the first GDP report, so much information is missing from it, which is why you get two revisions over the next, 8 weeks or so. Anyway, so let's get back to the non-farm payroll. On Friday, the figure was 943,000 jobs were created in the month of July. 1 month. And a lot of economists are now starting to think we're going to get a million jobs number for August. And when you have that kind of job growth, and the unemployment rate dipped a little bit from 5.7% unemployment to 5.4%. So we could get back to the fours, maybe the threes. Goldman Sachs, which I'll go over with you in a moment, came out with a number that thinks we could get there. It things are moving along really well in the economy, but then we push into or should say, and then COVID pushes in. We've got the Delta variant, and everything I'm reading is that it's the Delta variant is like the most contagious virus possibly that we have ever discovered. The Delta variant, it's extraordinarily contagious, more so than the original COVID, more so than the British strain of COVID, more so than Ebola. So it's spreading like wildfire all over the place. And a lot of people, a lot of investors and economic participants are worried. Now, economic participants, I mean consumers, people like us, we are economic participants. Do you stop going to events now? Do you get more cautious and say, you know what, maybe I don't need to go to the movies, I don't need to go to a restaurant, because the reopening was coming on really, really strong up until about a month ago. And all of a sudden, we've got a massive amount of cases, particularly in a couple of states where vaccination rates are low. Now, where I live up in Long Island, cases are going up a lot, but they're going up from a very low base. So it's still a pretty small and, problem here, still very manageable. And I do see all over the place when I go out that more and more people are wearing masks in supermarkets, in the mall. I know in the common areas in the office building I'm in, A lot of people are wearing masks in the common areas, to the bathrooms. I am one of those people, by the way. Just, it couldn't hurt. I still wear my mask when I walk into the building and walk out of the building. In my office suite, I don't wear the mask, but when I leave the suite, I do put it on. But that's me. So the point is, do we see a slowdown? And what happened is Tom Lee, who is a very well-known market caller, analyst, um, owns a firm called FundStrat. He used to be, I think he was chief investment officer or chief investment strategist at JP Morgan for a long time before he opened up his own shop. And he made a good point, and I'll pull that up on the screen. In fact, I think what I'll do is I'll pull that up on the screen right now. It's a really interesting point, and I think he sums up the entire bullish case for the market. Okay, pop myself up in the corner here. This is, I hope it's okay to show this. This is from the paid service of CNBC. CNBC has a paid version as well as the free version, obviously. Okay, so he thinks the biggest wave, if it peaks, he thinks, obviously we're in a big wave, but India and England had a massive COVID wave of the Delta variant. Okay. And he said, this is what he said. He said, let me make this bigger so you could see it on your smartphones. Okay. Hopefully you could see it. All right. He said, clients are so nervous about the Delta variant that they're only going to believe it until they see it. I think meaning that they'll believe we're through the worst of it when they see it, and they're not doing anything until then. Referring to a retrenchment in U.S. cases. However, he added, I think if COVID is retreating in the U.S. and we don't have a fall wave, we're going to have a big rally. He said we're going to have an everything rally. That's his expectations. He didn't say we are. He said he expects it because he expects that about 45. Let me pop that off the screen. He said about 45 days to 50 days after the the surge hits of the Delta variant, it starts to crest. And what he's looking at, he said, even in Florida, the growth is still there in terms of the variant of infections, but we went from I don't know, a smaller amount to over 100,000. But he said that it's not growing as quickly. The numbers are starting to not go up as much, and it's cresting, and it'll start to go down. And at that point, investors get used to the idea that we're not going to go into a shutdown, and that he thinks will put a really huge rally into everything from stocks to crypto to anything with risk. He expects will trade higher. I see a few of you out there, by the way. Thank you very much. Judy with the heart, love you. Josh is out there. Hey, buddy. Hey, buddy. How are you, my man? So nice to see you. Thank you very much. You and I got to get lunch. I know we talk about it. I've been trying to get lunch with so many people, but I don't know what happened to the time. It's flying by. The summer's almost, I don't want to say the summer's almost over because it's like the most depressing thing you could say to me is the summer is almost over because I love summer. Okay. So that's where we are. Does COVID slow the economy down? I don't think we go into a shutdown because so many people are masked up. But the headlines are scary that there are so many children getting serious COVID infections. And generally what pediatricians are saying is they're getting it from their unvaccinated parents. The parents catch it and they bring it home to the family. And children's hospitals in Florida, especially in Louisiana, are full. And it's a concern because kids come in for car accidents and surgeries and elective surgeries, whatever. And it's how do you take all the kids in? It's scary stuff. All right. But we do have half the country fully vaccinated, and those numbers are going up. Hopefully, you don't get the Lambda variant in here. That's what the next thing is expected. The next variant it's the variant called whatever I just the epsilon, is it, or the lambda, whatever the next Greek letter is after delta. I used to know the Greek letters. I don't anymore. I think it's Lambda. Whatever. There's a new variant that there's a new strain, a new mutation. That's it, a new mutation that might be declared a variant, like an actual variant. Oh, gamma. Josh says gamma. Thank you very much. Yeah, that's it. So the gamma. Okay. Um, so that's something that we have to watch out for. But are we going to have a shutdown like we had in 2020? I don't think so. I don't think the public has the tolerance for it. But the other thing is we're done with stimulus. Like we're not getting another payroll protection plan. We're not getting that. Thank you. We're not getting another round of checks. We're not expanding the unemployment again. As a matter of fact, Goldman Sachs, I'm going to show you their article too, if I could pull that up on my screen. But there was a really good article today that Goldman Sachs expects, and I think they carry a lot of weight when they speak, that there's a lot of employment. The labor market's getting hotter and hotter, and as more and more states drop the federal unemployment stimulus, the extra $300 per week, which is ending for all states in September next month, that they expect that'll add an extra 400,000 plus jobs to the payroll ranks over the next month or two. It's pretty significant, but things are getting hotter. So I'm trying to get to circle this thing here. If the variant gets worse and slows the economy down, interest rates go down, which they've already gone down a lot to like 1.13% about a week ago. They've been going higher, though, ever since. I'm talking about the 10-year yield, the yield on the 10-year Treasury. And that would mean the Fed stays, easy for longer, looser for longer. Okay. They're not going to be in such a rush to taper their bond buying program. The Fed buys $120 billion worth of bonds every single month. 40 billion of mortgage bonds, keeps mortgage rates low, stimulates the housing market. And they buy $80 billion worth of treasuries, which overall keeps long-term interest rates low. Good for borrowers, good for refinancing, keeps money circulating in the financial system. It does a whole bunch of good things, but too much of a good thing is not a bad thing, and people are worried about inflation. And now there is inflation now. Fed says it's temporary because of supply bottlenecks, that because manufacturing and oil drilling, things like that were shut down or substantially reduced, and now they're coming back online. But demand came back first, so it's taking a while for supply to catch up to demand. And when it does, prices will start to moderate and go back down again. We shall see. But the longer it takes to happen, the less believable that story actually is. And the labor market still has a ways to go. Now, the Federal Reserve wants the labor market to keep improving. That's something that they said they're willing to accept higher than their 2% target of inflation in order for a stronger labor market. We're getting exactly that. So what we need to focus on is to circle the square or square the peg. I don't know, whatever the expression is. I see Robert Waxman custom printed T-shirts, hoodies, embroidery, promo products. Something Third is out there. Hey, Robert, nice to see you. Thank you very much for joining me. I really appreciate that. And hopefully the sound is coming in nice and clear. Oh, gee whiz! Did you guys lose me for a second? I do get to tell you, really, I think there's so many people streaming that it's stressing internet speed in my area of the world. Ooh, I cranked it up for a second. I hope I didn't mess up your ears there. Ooh, I just messed up mine. Okay, so but we're getting this faster opening, but now the COVID hits, and is that going to slow things down? The price of oil plunged today. Oil stocks are down across the board. Gold tanked. There was a flash crash in gold this morning, down over 5%, which is a huge move for the price of gold. A lot of people don't really understand why. Okay, so let's see if I could pull this up. I want to show you something. Okay, me get. Oh boy, it's not going to my fourth camera. I'm kind of stuck on my third camera. Let's go back to camera one. I'm going to read you this. Goldman Sachs. The remaining states, we're talking about the payments, the federal unemployment benefits, in addition to the state benefits. These remaining states account for over 3 times as many benefit claimants, the states that are still paying out that money, as the early expiration states. Okay, so there's 3 times as many benefit claims as the early expiration states, meaning that most of the impact of expiration is yet to come. The Goldman economists said they expect a boost of 400,000 jobs just in September from the ending of the benefits. That's pretty huge, and they expect that to continue. So it looks like to me that the Delta variant hasn't really impacted the economy yet. There are parts of the country it'll impact, and it's having a little bit of an impact, but it's nothing drastic. It hasn't turned away the reopening part of the reopening phase of the economy, the economic rebound. Some stocks are trading like we have a recession coming in, and the bond market certainly was telling you that we're going to have a problem with this COVID variant, Delta. But all of a sudden, the last week or so, interest rates are starting to go back up. And it's just we're going from we're going into another recession, another shutdown, to we're going to skate right past this. And it's like the psychology job that this is doing to investors. We're just going back and forth and back and forth. We're going from up reopening stocks to down reopening stocks to up work from home, stay at home stocks to down work from home, stay at home stocks. This is one reason why I say I want you to have both. I want you to stay diversified. Okay. I want you to just keep owning both of these kinds of stocks. Diversification, which is a strategy that doesn't necessarily protect you in a down market, doesn't protect your portfolio from going down in a generally down market, but it does help minimize risk, and it can help you recover quicker. So these are the things that I'm looking at. So we expect the unemployment rate to continue to go down. We expect the Fed to start tapering. Now, so this is the last thing I want to talk about. When does the Fed taper? I'm seeing estimates, and I've been writing about this, talking about this, anywhere from November of this year up till March of next year. It's coming up pretty close, pretty quickly though. It's coming up pretty quickly. If the Fed starts to taper, when it tapers, not if, when it tapers, meaning, you know what I mean by taper, by the way? It means if the Fed's buying $120 billion worth of bonds and they decide to reduce that, instead of saying the word reduce, they use the word taper. They could have just said reduce instead of taper. Everyone has to use their own special brand of fancy word. And not that taper is such a fancy word, but they could have just made it simple. But they'll taper, and it's expected to take about 10 to 12 months to taper to get to zero bond purchases. At that point, then the Fed could consider raising interest rates. We're at 0 to 0.25% on the Fed funds rate, and the Fed could let that go higher to maybe 0.25% to 0.5%, which is still very low. But typically, once you get 3 or 4 Fed rate increases, that's when you start to feel it in the stock market. It takes a couple of months, up to 4 to 6 months, for a Fed rate hike to work its way through the economy. But the Fed could do it pretty quickly. So I don't know if they're going to raise rates every 6 weeks or every other meeting. The Fed meets every 6 weeks. But if they start tapering, let's say in November, all right, so that means by May, we're going to be through the taper of 2022, and we could start seeing rates go up in late 2022, which is definitely on the earlier side, but it doesn't seem like the stock market is reacting too negatively to that. It doesn't seem like anybody's reacting negatively to that, which means the Fed did its job in beating us over and over the head, telegraphing us that they're going to go slow, stay low, and that's the path that they're on. It's kind of like putting the story of the frog in the water, but there's a fire under the pot that the frog is in, and it starts out cold and heats up so gradually that the frog doesn't realize the water's hot until it's already boiling. Maybe that's what'll happen to the stock market. But we're all out here looking for, when does the economy go into another recession? Doesn't look like it's happening anytime soon, in my opinion. I don't see it at all anytime soon. But we are also talking about, when does the stock market go down? We talk about the stock market like it's going to just take a hit, like boom, it's just going to stop, light switch off, and it goes right down. The thing is, if you're bearish, or if you're worried about the stock market, you're worried about the economy, what that means is, every time bad news comes out in the economy, you'll automatically interpret it as saying, oh, this is it. This is it. The market's going down. The economy's going down. The stock market's going to take a big hit, big reset. And every time good economic news comes out, because if you're worried about the market, you'll say, this is bad, because now the Fed has to jack up interest rates. They've got to scale back on their bond buying really fast, and they're behind the inflation curve, and they're going to jack up rates so quickly that they're going to kill the stock market and kill the economy. And I just feel like investors are so I feel like investors are so scared of their shadow, of every little thing that's coming their way. And in a way, it's good, because it means risk doesn't investors taking it means that investors aren't taking too much risk in a lot of ways. And I think, by and large, there are pockets of crazy risk, meme stocks, crypto. But before you don't at me because I said that. You could say, "Oh, crypto is going higher." It's how dare you say it's crazy risk? Look, I'm thinking in terms of an ordinary. I know none of you are ordinary. In terms of a average client, oh my God, I know you're not average. We're saying is in terms of like the average. I don't know why the goddamn screen's blinking. It's really pissing me off. In terms of the average ordinary investor who's saving for retirement, saving to put their kids through college, investing in the stock market, either through, index funds, mutual funds, ETFs, or even individual stocks. You have to admit that crypto is it's a pretty risky proposition. It's a lot higher up on the risk curve than stocks are. That's all. Now, you could be compensated for that risk by having a much greater reward in crypto. I'm not knocking that thought process. I'm just saying that, when there's so much money in the system, that it's lifting all boats. I hope that makes sense. All right. So that's the big update for the day. I want to talk to you more about personal finance, Roth IRAs, and traditional IRAs, and 401ks and rollovers, but we need to talk about these things. But really, what I need from you guys is hit me up with questions. You could DM me. If you're watching me now, it means one way or another, we're connected on social media. So send me a DM, an idea or a question that you have. I'd love to hear from you. And that's about it. Remember, this is Be the Boss of Your Money. I do this every Monday through Thursday at 4:30 p.m. Eastern. And I wish you a very good rest of your Monday. Signing off.